Sandeep Sabharwal also joins us on the show. Let's discuss the fundamentals with him. I wanted to begin by discussing JSW Energy with you because over the weekend they announced a very large transaction, in fact the largest in their history and one of the largest in the country, wherein they bought O2 Power at the valuation of 12,500 crore thereabout. It's a good asset coming in at a very reasonable valuation, and we have seen the brokerages give a thumbs up as well. Do you track this one, Sandeep, at all, or anything else in the power sector that looks interesting to you?
In terms of the power generation utilities, the main issue with all of these is that the ROE remains very low. So although there is excitement about growth, etc., but the return on their assets historically has been very low in single digits and expected to be remain the same going forward also. So in that context, long-term sort of attractiveness of these companies is low. But in the near term, news flow can drive. So you said that this asset has been acquired at a reasonable valuation. Actually, I have no idea.
Sandeep, what about consumption and as a basket? And we were just discussing how over the weekend there was that clamour of increased tax cuts, that till 15 lakh rupees there shouldn't be any tax liability, etc. I don't know if it's just the wishful thinking here, but do you think an effort from the government with respect to tax rebates is something which is necessarily needed to spur consumption at the mass level?
Yeah, so it's been needed for some time, but the government has not been inclined to give tax reliefs. So there is very little reason to believe that they'll be doing it this time also, because not giving these tax reliefs has not impacted the electoral prospects. So I think the NDA has been winning most of the state elections by a good margin. So they don't see any need to take these measures politically. Now, economically, there is a need because consumption has been stuck in a groove for more than 2 years now, not moving. And ultimately, if the consumption doesn't move, the capacity additions across the board, because ultimately everything needs to be consumed. So if consumption remains slow and it's becoming and becomes slower, then the entire ecosystem gets impacted. So we need to see whether that realization is there or not.
Sandeep, anything that you like within cement or are at least keeping on your radar to buy?
Not in the near term, Aisha, because of the fact that these companies have been trying to increase prices for the last 1 year now, or even more. And they increase the prices and they roll it back because the supply increases so much more than demand increase, that in a commodity industry, like there's very little they can do to take the prices higher. They have been helped in terms of profitability because of low input prices, and that's helped them sustain profitability. But valuation across the board and the cement sector continue to be very high for a commodity industry, which over the next 2 years will be facing a scenario where supply increases will be much more than demand increase. So I would not be looking at this sector overall at these prices of stocks across the board. Maybe if they become cheaper or they go through a longish consolidation, at that time we can consider.
Also wanted to ask you, you said something that I noticed supply is going up, demand is remaining the same. That's exactly what's been happening with the real estate space as well. What are you making of this sector going into 2025? Because the first half of this year has been pretty decent, but the second half, especially the quarter that is going on right now, is seeming to be rather shaky for real estate players on the back of delay in approvals and a lot of other headwinds coming in for this sector. Do you believe recovery is on the charts for at least the real estate space going into next year?
So real estate companies took prices high substantially. So the price increases were very rapid, and at that time the supply was getting absorbed. But eventually, I think in an economy where consumption overall has been slow, so real estate can, as a standalone sector, it's very tough for it to continue to do well. So that's why we've seen volume pressures come in the second half of this year, which could actually continue going into 2025. So a big part of profitability increase of many of the real estate companies has come due to increase in prices per square feet realizations have gone up. That might not happen in 2025. So real estate overall, because there are many regional players, so there could be specific opportunities here and there. But overall, as a sector, looks overvalued.
Sandeep, that brings me to Paytm. That's been quite the revival story, if I can call it that, of the year gone by, right? Your thoughts on where the story is going to move from here?
I think they've been able to divest a few assets, raise some cash, etc., and then some restrictions also got removed. But I think the proof of the pudding now will be in them delivering. So, in my in my view, I think a lot of the profit increases in the recent past, like last couple of years, were due to their loan origination businesses and the commission they were earning on that. And those, because of whatever is happening on the lending ecosystem, RBI restrictions, etc., will remain slow or actually fall. So now, where the overall revival is going to come, which will help the stock price sustain the kind of rally it's seen, is something we need to see. I would not be a buyer at these prices.
But Ola, that's going to be one story which is definitely going to be in focus, especially after the long list of exits that have happened. Sandeep, what's been your take on this? Because, this is another one of those stories which will definitely go down the history books when you talk about the year gone by. Started off with those bunched up consumer complaints, which weren't quite addressed. The management tried to do a little bit. And now these senior level exits which are happening.
So why these senior level exits are happening, that we are not privy to. So very tough to figure out. Maybe many of these senior people were waiting for the listing to cash out on their stock options, etc. But overall, from whatever the market feedback, etc., is the product quality of the company uh, and the customer feedbacks and the satisfaction are low. That's one part. Secondly, the legacy players have become much more aggressive, much more serious, coming out with better products, and it's very tough for it'll be very tough for Ola or any other standalone EV company to match the kind of service network, etc., of, let's say, a Bajaj, TVS, Hero, etc. If their product quality are similar or even if a little bit inferior, the customers will prefer the legacy companies, has been my long-standing view. So I think it's going to be a tough period for Ola Electric. How they are able to retain their market share, or are they able to improve profitability from deep losses, will be something we'll need to see. But looks unlikely.
Sandeep, while we were talking about cement and the price hikes that that sector has undertaken, even consumption is a space that is currently undergoing a lot of pricing action. There's been a reduction in on the grammage front as well. I'm talking about some pure play FMCG companies. What's your outlook on this sector going ahead? And if you had to play the consumption space, would it be via pure play FMCG, or would it be something via retail, or would it be footwear, or what would your preferred way be to play this entire consumption space heading into the next year?
Consumption is the contrarian sector for 2025, in my view, because it's been depressed. Stock prices are down. Even the large consumer companies are down 30-35% from the top. So this includes companies in retail, companies in QSR space, companies in, let's say, the pure play FMCG consumer segments, etc. I think many of them will do well in 2025. So if, let's say, hypothetically, the view is that the Nifty could rise 8 to 10% in 2025, then even many large FMCG companies with low volatility could do possibly double of those returns. So I think it makes sense for investors at this stage, given the current valuation, to have some exposure. So among the larger companies which have fallen due to various reasons like slow consumption, then palm oil prices shooting up, which impacts their profitability on the input side, etc. Companies like Tata Consumer, HUL, Godrej Consumer, Dabur, I think all of them are reasonably well placed at current prices to deliver double-digit returns in 2025.
Sandeep, anywhere where you've profit taken as we approach the year end? Sandeep, the question was, yes, I asked you, anywhere where you may have taken some profits off or at least reduced exposure?
Not lately, but during this year, we largely got out of most of the railway stocks because we made good money, because my view was that the railway capex seems to be peaking out. We exited stocks like Tata Motors, etc., where we thought the fundamentals and seem to have peaked out, etc. But that was much earlier. In the near term, now, given the way markets have done over the last 6 months, given the correction which is playing out, it's more to look for opportunities to buy now.
Interesting. And perhaps one trigger could well be the budget as well, right, Sandeep? I mean, we are expecting and anticipating some amount of defense allocation, not railways, but what about defense? Because for a large part of the year, both defense and railways were pretty much clubbed together, and that bout of profit taking which came by when some of the railway stocks, cracked quite a fair bit, even defense cooled off.
Yeah, so defense is a much more durable sector than railways, because in defense, there is strategic intent of indigenization, and there are large projects and there are large allocations, and especially on the capex side, the shift is clearly there from revenue expenditure on the defense budget towards more of capital expenditure. So I think to that extent, defense remains a much better play. And in that, there are a few private sector players, but largely PSUs. So I think some of these could do well. So right now, because they became so overowned, they are going through a phase of consolidation, which could again continue for some more time. But then longer term, many of these companies do have the order books, and execution will pick up, and they should do well.
Sandeep, soon we'll touch upon earnings, and it'll be IT to start off the quarterly numbers. What is the anticipation this time around? Where do you think sectorally one is bound to see EPS pressure continue, and where do you think the positive surprise could come in, if at all?
I think subsequent to the second quarter results, we saw downgrades across a large variety of across the board, actually. Now, I think we are in a scenario where we are actually seeing that the expectations are low. So to that extent, the probability that we could actually see a broad-based outperformance of muted expectations is much greater than being downgrades also in this quarter. So I think let's see how that goes. But overall, I would not go into this result season like I was last season, cautious. This season, I think we could actually see that if there are some positive surprises and the stock prices are depressed, that could lead to upsides.
Let's see, not as cautious on the entire earnings season, maybe signs of bottoming out.
If you like this video, then like, share and subscribe to ET Now.